This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, appropriately, now we are left with one final scenario to deal with in this final lecture on loss reliefs for the unincorporated trader. And that is what happens when we come to the cessation of an unincorporated trade and we have losses in the closing years, probably in terms of any exam question, in the very final period of trading. How do we deal with that? Well, just like we were dealing with in opening years, we must firstly establish assessments and the losses in those final tax years. I say that unless there is a very, very specific requirement, which is to compute the specialist closing years relief known as terminal loss relief. If you got a question which said calculate the amount of loss available under the terminal loss relieving provisions, then, as we'll see just a little later on in this lecture, you would go directly to the working required to fulfill that goal. But if we're working out the levels of taxable income after all loss reliefs have been applied, if we're advising over what loss reliefs are available and which should be chosen, then we do it this way. So to begin with, it's like any cessation of an unincorporated trade. Work out which tax years we're dealing with, establish the assessments, and of course, where there are losses, what losses arise in relation to those final tax years. If we do have any of the tax years with a basis period of loss, then we must consider what loss reliefs. If we're dealing with the final tax year, then clearly there will be no carry forward post the cessation of trading. There's no carry forward because there's no future trading profits of the same trade you've ceased trading. There would, however, be your normal possibilities of relieving against total income of the current and or preceding tax years. And if you've made such a claim for either of those years, then for that particular year, you may consider the possible extension claim against your chargeable gains. So all of those are your normal reliefs available when you sustain a loss in relation to a tax year. But there is then a further and, as we said, specialist terminal loss relief. Now that will demand its own separate calculation, so let's just deal with the first part of this problem, establishing assessment losses in the final tax years, and consider the normal loss reliefs against total income of current preceding year and the extension claim. Once done, then we will look at the very specific calculation of what we refer to and know as the terminal loss relief. So to assist us in this matter, let's have a look at a little example that we have set up for you here, if you'd now be so kind as to note down the information. We have got here Cameron had always prepared accounts to the 31st of December in each year, before then ceasing to trade on the 30th of September 2017. We're then told what the relevant and recent tax-adjusted trading profits or losses were, and as we see, for what were the years ending December 15 and 16, we've got descending profits. The writing is on the wall for this business. And then, sad to say, what finished off the business, a loss-making period to the 30th of September 17, when a loss of £30,000 arose, at which point, as we were told, the taxpayer, Cameron, ceased trading. Also, as is relevant for final tax year, we need to know about the overlap profits, if any, that arose within the opening years. And our overlap profits here from the commencement of the trade amount to £6,000. So there's the information, therefore, that we need to be aware of. Had prepared accounts to 31st of December, their year to December 15, year to December 16, profits of £40,000 and £20,000 respectively, before ceasing to trade on the 30th of September 17, where we finished for that final period with a tax-adjusted trading loss of £30,000. Overlap profits from our opening years, £6,000. Right, let's remind ourselves of how we deal with a closing years problem and what we do first. First thing we do is to identify what is the final tax year, based, of course, on the date that you ceased to trade, it here being the 30th of September 17. So that therefore puts it in the 17-18 tax year. So having established what is the final tax year, the technique, you would then go back to the penultimate tax year and assess using CYB. You would then allocate any remaining period or periods to the final tax year and bring in the overlap profits as a deduction in deriving the trading income assessment, or here as it will be, adding in to derive the trading loss that arose for that final period. So let's therefore put that to the test now and follow through with our calculations. Right, remember, as we've said, allocate, well, first of all, establish what is the final tax year based on date of cessation, and we know that that is the 2017-18 tax year. Leave it, go back to penultimate tax year, and that must therefore be 2016-17. And we assess using CYB. Cameron had previously been preparing accounts to the 31st of December, so which 31st of December, therefore, would end within the 16-17 tax year? That, of course, would be the year ended the 31st of, the year ended 31st of December 16. Year ended 31st of December 16, what did we have? We had a profit of £20,000. Profit £20,000 there. Having determined the assessment for the penultimate tax year, obviously any previous years would be assessed on CYB as well. So for us, we could go back as far as 15-16, CYB, and that, of course, accounting year ended 31st December 15, and that was a £40,000 trading profit. But to get our assessment then for the final tax year, what do? We know that in 16-17, the penultimate year, we've come as far as the 31st of December 16. What remaining period or periods do we then have? The remaining period that we have is the period to the 30th of September 17. The 30th of September 17. So we now pick that up, therefore, period to the 30th of September 17, in which we made a loss of £30,000. No other periods there. We now allocate the overlap profits or overlap relief, as we may now call it, to this period. That is £6,000. Now that would have reduced any trading income assessment, so it increases any trading loss, and that therefore gives us a loss overall of £36,000, and of course what is then a nil assessment for that tax year. Now, having got your assessments and your loss for the final year, we can now consider what loss reliefs are available. You've got a loss of £36,000. So what I'd like you now to do, please, is to note down how and where that loss could be used using your normal principles of set off against the total income of the current tax year and or the preceding tax year, and noting, of course, the possible extension claim as well. Just note those down, and what we'll then do is to consider separately the new bit: how do we compute and how do we relieve this so-called terminal loss? So pause at this point and establish what your normal reliefs would be in relation to the loss of £36,000. Okay, well, as we identified, the final tax year was the tax year of loss. That was 2017-18 tax year, and we calculated an amount of loss available of £36,000. Ignoring for the moment the terminal loss relief available, what are the normal reliefs, or of those normal reliefs, what would be available here? We could set off against the total income of the current tax year, 17-18, and or the preceding tax year 1617. Clearly what we don't know is whether we had any other income other than from the trade. We do know that in 1617 there was a trading income assessment, of course, there of £20,000. So there would be some profit there, some income to be assessed. But we need to know the information about the other income, should there be any, of the taxpayer. If we do make a claim for either of those 2 tax years, and having made that claim against total income there is loss left over, then a possible extension claim against chargeable gains would be available to us. But if you get this situation of closing years, almost inevitably the relief that they will want you to deal with is the terminal loss relief. So it's that now that we need to see. What can you do with it once you've computed it, and how do you compute it? So if we go back therefore to our notes, Section 6 of Chapter 7 here on page 53, we've got our terminal loss relief note. The terminal loss as computed, we'll see that computation in a moment here in Section B, is set against the trading profit for the tax year of cessation. Now, this again is quoting the law. It is possible that you could have a trading income assessment in the final tax year, yet still on the calculation of terminal loss end up with a terminal loss. It is most unlikely, because almost certainly we will find in any exam question that there is a nil assessment in that final year because you have finished with a loss-making period. So we say here, if any, note it's usually a nil assessment. And that's the case in the example we've got. In 2017-18, when Cameron ceased to trade, there was a nil assessment. So normally what you then do, and what would be the immediate use of the loss, is to set against the trading profits of the previous 3 tax years, and on a LIFO basis. So interesting stuff here as compared to what we've previously done. This relief is against trading profits. Guess really it makes some sense. We know that as you've ceased trading, there is no possibility of carry forward. Had you have carried forward, it would have gone forward against future trading profits of the same trade. So I guess the logic here is if you can't go forward, you can go back. So we can go back against the trading profits of the previous 3 tax years. And this, therefore, on a LIFO basis. So in our example, when we ceased trading in the 17-18 tax year, we now could take our terminal loss back against the trading income, the trading profit assessments of 16-17, 15-16, 14-15. It goes back on a last in, first out basis there, from the most recent year back in time. But the calculation of the terminal loss is different to what we have seen already in computing the actual loss of the tax year. This has got its own very specific calculation, and it may lead to a terminal loss being lower than the actual loss sustained. And that's what we've now got to see. The terminal loss is the loss of the final 12 months of trading, and that final 12 months of trading is likely, of course, to span both the final tax year and a part of the penultimate tax year. It is very unlikely that you've ceased trading on the 5th of April. So the last 12 months of trading will cover however many months of the final tax year in which you have traded, plus the balance of the last 12 months that fall back in the penultimate year. And that's important because we've now got to do this calculation in 2 parts, dividing that last 12 months of trading between, as we have just said, how much of it is in the final tax year and how much of it is in the penultimate tax year. So the calculation in 2 parts. Firstly, the actual trade loss for the tax year of cessation, taking it from the 6th of April to the date of cessation. So what loss was there from the 6th of April, the start of the final tax year, through to the date of cessation? Plus, we can add in any overlap arising from your opening years. It is allocated to the final tax year. Secondly, any actual trade loss for the period 12 months before cessation until the end of the penultimate tax year. So the bit of the last 12 months of trading that falls back into the penultimate tax year. And if it happens, it's a relatively rare event, but it could happen, and we'll see how in our calculations in a moment. But if your result in either 1 or 2 above should actually give rise to a profit overall, then for purposes of the terminal loss computation, it's treated as 0. It is nil. More of that in a moment's time. Let's therefore go back now to our example on Cameron, whereby we saw that we had this information here. So ceased trading on the 30th of September 1718 was the final tax year. We finished with a final 9-month period down here, the final 9-month period to the 30th September 17, amounting to 30,000. And prior to that, the penultimate accounting period to December 16 was a profit of 20,000. Plus, of course, we know our overlap profits were 6,000. Right, let's see, following the note that you've got on the calculation of the terminal loss relief, how we do that calculation now. Okay, our terminal loss computation. Firstly, we look at the final tax year, 2017-18, and we take firstly, the first part of this, the loss from the 6th of April at the start of that tax year, the 6th of April 17, through to the date of cessation, and that was the 30th of September 17. That, therefore, from 6th of April to 30th of September, we do it to the nearest month, of course, is 6 months. And it's out of what was a final period of trading of 9 months, from the 1st of January of 17 to the 30th of September 17. So we will take 6 of those 9 months of loss, and the loss made in that period was £30,000. 6/9 of 30,000, 2/3 of that, is £20,000. And secondly, we add into that any overlap profits, any overlap relief, and that we knew to be 6,000. So in total, therefore, we've got £26,000 worth of loss falling into the final tax year, so far as our terminal loss calculation is concerned. Now that, of course, only deals with that part of the last 12 months of trading that falls into the final tax year, from the 6th of April 17 to the 30th September 17. What we've now got to do is to go back to the penultimate tax year, that is 2016-17, and establish what amount of loss, if any, falls in that period. So that is the period from, well, we ceased trading at the 30th of September, so a date 12 months prior to that is the 1st of October 16, through to when the penultimate tax year ended, the 5th of April 17. So what goes into that period? If we work back in time, then we've allocated 6 of the final 9-month period of trading's loss to the final tax year. So we've now got the remaining 3 months of that falling into this period. 3/9 of 30,000 will therefore equal, what have we got there? That's going to be £10,000, of course. Right. We now need another 3 months to take us back to the 1st of October, and that 3 months is taken from the penultimate accounting period of profit, in which we made a profit of £20,000. 3/12 therefore of 20,000 will be £5,000. And that net loss for that period therefore comes to £5,000. Add it to the 26,000. 26,000 plus 5 equals a terminal loss of £31,000. We have a terminal loss of £31,000 there. Now, what can you do with that terminal loss? We can set off, of course, against the trading income assessments of the preceding 3 tax years. So again, in the time-honoured fashion of a columnar format presentation, we know that we've got the final tax year, 2017-18. We've then got information for 2016-17 and 2015-16. Our trading income figures for these years, nil. We had the loss in the final year. We then had 20,000, as we've just said, assessed in 16-17 and 40,000 in 15-16. Now, if the loss were bigger, or these income figures for these 2 years, 16-17 and 15-16, were smaller, we could have gone back as far as 14-15 in relation to the use of the terminal loss, but that will not be necessary here. In terms of your terminal loss relief, we have available to go against trading income £31,000 on a last in first out basis, so we go back to 16-17 to begin with, so that £20,000 would go. We've used 20 out of 31, that would leave £11,000 to be set against the 40,000, bringing that down to £29,000. So the terminal loss relief set off against just the trading income figures of the previous 3 tax years, on here, of course, a last in first out basis from the most recent year going back in time. One final point just to take you through, as per mentioned in the note. It said that in your calculation of terminal loss, that if either this figure of loss or this figure of loss there, computed in either point 1 or point 2, if that were to be a profit, then it would be treated as nil for purposes of your terminal loss claim. What that means here is it's inapplicable because you've got £26,000 of loss there, £5,000 of loss there, put them together, there is £31,000. What it would, however, mean that if when doing this calculation you were taking, we had a profit of £20,000, if that had been a profit of £120,000, then 3/12 of 120 would have put a £30,000 profit in instead of 5,000, as we see there. Now that would have meant that the net outcome, 10,000 loss, 30,000 profit, would be a net profit. What the note tells you is if the figure is a profit, you would treat it as nil for purposes of the terminal loss computation. So you would not net out what there would be a net profit, loss 10, profit 30, you'd have a net profit of 20,000. You do not put that into this calculation here, because you'd be netting 20 against 26, you'd only have terminal loss of 6,000. You don't do that. It is a nil figure that goes in, meaning that your terminal loss would remain at £26,000. Now, it's a relatively rare event, but it is something you should be aware of. So here, loss £31,000. One final overall point in terms of these losses, again, if they ask you simply to compute the terminal loss and in a written question show how it would be relieved, you now know how to do that. We can deal with it. But if you had to advise on the use of losses overall, of which the terminal loss is one, then be aware we have had available £31,000 of loss to use under the terminal loss relieving provisions. But if you remember where we started, we computed that we had an actual loss for the 2017-18 year of £36,000. So what that would mean is, though limited to £31,000 worth of terminal loss relief, the remaining 5,000 of this actual loss of £36,000 made. It's not forgotten, it's not abandoned, it's not wasted. It is available for your normal loss reliefs. Now, that's probably just going to restrict you to your total income claims. And given that you can only go against the total income of the current tax year and or the preceding tax year, then there may be very little, if any, income against which the extra 5,000 could be relieved. But if you asked to discuss in a written question what the available options were, the 31,000 as shown, relieved as terminal loss, it would still leave the remaining 5,000 out of the actual loss of 36 available to be used against the total income of the current tax year and or preceding tax year, or boosted, again extended if necessary, then against capital gains. So those loss reliefs would still be available on the remaining 5,000 of the actual 36,000 loss that has not been available for terminal loss relief, which, as we see, we computed to £31,000. Right. What that now means is that we ought to be able to compute a loss for any tax year, and whether that tax year be the very first tax year or any other year through to the final tax year, we should be able to establish what loss reliefs are available and show how and where those losses would be utilised. Where choice exists, remember, what we are seeking to do is to get the best use out of that loss. And again, to cover that, we mentioned in our introduction to losses, the objectives that we have in mind. We would wish to avoid wasting, as we've seen so many times with these total income claims, we'd seek to avoid wasting our personal allowance. Always a problem with any claim against total income, because remember, partial claims are not allowed. We'd also like to use loss reliefs earlier rather than later, cash flow. If I can carry a loss back, that will give me a repayment from earlier tax years, which is better than reducing this year's tax, which is still to be paid, which in turn is better than reducing future year's tax, which of course will be paid even later. So cash flow. What we also have to seriously think about is tax rates. I would rather take out income that was taxed at 40% than income that was taxed at only 20%. If in one tax year I'm a higher rate taxpayer, if I'm able, I would rather use the loss in that tax year than within a tax year in which I am only a basic rate taxpayer. So there, therefore, are your principal objectives. Avoid wasting your personal allowances, claim relief at the earliest available opportunity, therefore a cash flow advantage, and then, of course, and what may be the most important, to gain relief at the highest tax rate. If I can take out higher rate taxable income and save 40%, that is better than only saving tax at 20% for income in the basic rate band. Okay, so now with our unincorporated trader, our sole trader, we're able to calculate tax-adjusted trading profits or losses, including the computation and deduction of capital allowances. We can then relate the accounting period in which the tax-adjusted trading profit has arisen. We can now relate that to a tax year of assessment. Chapter 6 are basis periods for first tax year through to the final tax year. And now, should the result of the calculation of the tax-adjusted trading profit instead end up as a loss, we know that for that tax year the assessment is nil, and we must then separately consider what are the various available reliefs that we may use, and either follow a given instruction as to which relief should be applied, or to advise which reliefs are available, state what our objectives are, and then choose the relief that best achieves that objective. All that now remains for us to do in the context of the unincorporated trader, which is where we go next in Chapter 8, is to deal with the fact that an unincorporated trader is not necessarily just a sole trader. We could have a partnership where there are two or more partners trading together within that partnership. How, therefore, do we deal with that in the context of income tax? And as you'll discover right at the very beginning of Chapter 8 in our next session together, is that we do not tax the partnership. Instead, we tax each partner on their share of the tax-adjusted trading profit, or, in the context of what we've just done, we will give each partner their chosen relief in relation to their share of the adjusted trading loss that has arisen. So, partnerships, therefore, are next on the agenda for our next session together.